In 2025, global energy investment reached $3.3 trillion, splitting into $1.1 trillion for fossil fuels and $2.3 trillion for clean energy. This 2-to-1 ratio signals a structural shift. As capital floods the electricity sector, energy growth is definitively decoupling from carbon-intensive supply chains. Clean generation has reached a point of extreme affordability. Learning curve economics have pushed the cost of solar photovoltaic modules down to approximately 30 cents per watt. However, this combination of cheap hardware and massive capital deployment has created a structural paradox. The physical system is hitting a wall. Across the globe, vast pipelines of solar and wind projects are stalled in interconnection queues. The generation is ready, but the physical grid lacks the capacity to receive it. At the same time, demand for power is becoming more rigid. Artificial intelligence and digital infrastructure require massive, constant loads, like this data center situated directly next to a solar field. The bottleneck of the energy transition has migrated. The primary challenge is no longer about adding nameplate capacity. It is about transmission and the firmness of the supply. We have moved past the era of climate pledges and into the infrastructure supercycle. Market capital is now aggressively rotating away from pure generation and rewarding the builders of the physical grid. Economic value is concentrating in the network infrastructure required to move electricity from remote renewable clusters to industrial hubs. This creates a scarcity. Solar arrays are modular and can be deployed in under 2 years, but high-voltage transmission projects often take a decade to permit and construct. Solving this requires high-voltage direct current, or HVDC, corridors, the specialized technology needed to stabilize variable power across thousands of miles. Investors notice the shortage. Siemens Energy saw its market capitalization surge 228% in a single year as the grid-first strategy became a primary market driver. This re-rating is backed by a €146 billion order backlog for grid infrastructure, representing years of guaranteed demand. GE Vernova reports a similar trajectory, with a $59.3 billion backlog fueled specifically by HVDC and grid stabilization components. To manage geopolitical trade friction, these manufacturers are pivoting toward localizing their supply chains near key markets. In India, Siemens Energy approved a 20.6 billion rupee investment to double its transformer manufacturing capacity, targeting the rapid expansion of domestic renewable corridors. These localized facilities supply the immediate needs of the Indian grid, while acting as an export hub for global data center infrastructure. This defines the first pillar of the supercycle, capturing high-leverage capital by hardware manufacturers who solve grid constraints. As the transition matures, standalone renewable assets face a high-stakes execution test. Without storage, these projects are increasingly vulnerable to price cannibalization during peak production hours. The new requirement for utility-scale success is the integrated hybrid asset. Adani Green's Khavda project in India is a global example of this model, aiming for 30 gigawatts of capacity in a single location. Khavda's differentiator is the rapid deployment of nearly 1,400 megawatt-hours of battery energy storage, or BESS, in just 8 months. At this scale, BESS functions as a primary infrastructure asset, providing the grid stability once reserved for centralized fossil fuel plants. Shifting solar generation to high-value evening peaks drives EBITDA margins past 90%. The Microsoft-backed recommissioning of the 3 Mile Island facility is the hallmark transaction of this era, linking massive AI compute loads with carbon-free firm power. We are also seeing the shift towards small modular reactors, or SMRs. These units move nuclear buildouts from construction sites to factory assembly lines. The SMR market reached $7.49 billion in 2025, supported by tech companies seeking dedicated on-site power for their server clusters. By utilizing factory fabrication, SMRs can be deployed in 12 to 24 months, avoiding the capital risks and decade-long delays of traditional reactors. The AI boom is re-establishing nuclear power as a critical pillar of global technology infrastructure. While advanced economies execute these high-tech strategies, the global distribution of energy capital remains deeply unequal. China and advanced economies capture the vast majority of clean energy funds. China alone accounts for 1/3 of total global investment. The disparity is stark. Africa holds 20% of the global population, but attracts only 2% of clean energy investment. The core barrier is a crisis in concessional finance. In some nations, crushing debt servicing consumes more than 85% of total energy investment. Without reform to multilateral development banks to address currency and political risk, the developing world remains locked out of the transition. Global net zero targets will remain mathematically impossible if the infrastructure supercycle is confined to the world's wealthiest economies. Success in the age of electricity depends on solving heavy industrial engineering challenges rather than just software or policy incentives. We see this in the shift of transition finance. Early-stage venture capital funding fell 19% in 2025 as markets moved away from conceptual startups. Capital is now flowing into infrastructure debt and corporate equity for late-stage projects. This value stack shows the market's preference for proven, scalable assets. Investors now demand amp-hour scale, the ability to execute massive physical build-outs and localized production. The required technology stack for the next decade demands HVDC grid modernization, integrated battery storage, and firm nuclear baseload. Strategic success also requires navigating trade protectionism by building resilient, local supply chains. The winners of this investment supercycle are the integrated platforms and original equipment manufacturers building the physical backbone of the 21st century economy.